Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index, the euro currency, and the gold markets for Monday, October 18th. Starting off here with an intraday 4-hourly chart of the US dollar index. You can see that by virtue of overnight's recovery above the 77.30 corrective high from October 13th, midweek last week, the market has confirmed a bullish divergence in short-term momentum. That exposes a correction of at least the latest phase of the broader bear trend from 77.93 down to 76.14. But given the magnitude of the broader slide shown here on the daily chart, we advise traders to first approach the past day and a half's recovery as another corrective stair-step ahead of further losses, with the key focus now on the 77.93 corrective high from October 12th. That is the specific corrective high the market is required to recover above to confirm a threatening bullish divergence in momentum, and in fact break this broader slide, this broader downtrend needed to expose a larger degree correction or reversal of at least the past couple of months sell-off from the 83.56 high from late August. If the market is successful in confirming strength above 77.93 and that bullish divergence in momentum, all bearish exposure will be advised to be neutralized to avoid the height unknowns of a larger degree correction or reversal higher. And the first area would be watchful for is the upper 79 handle. That's the 50% retracement of the past couple of months break from 83.56 to 76.14, and it correlates pretty well with the former support from early August around the 80.08 level. It's also interesting to note from a weekly log scale perspective, the market's respect thus far at least, of the long-term uptrend connecting the March 08 and Novo 09 lows as a result of at least the short-term bullish divergence in momentum. But we don't want to put too much stock in this low to this point until or unless the market can confirm a larger degree correct bullish divergence in momentum above that pivotal 77.93 level or high from last week. In sum, this recent recovery is sufficient to warrant shorter-term traders with tighter risk profiles to neutralize or pair bearish exposure and move to a more neutral sideline position. But from a longer-term perspective, we're still requiring strength above 77.93 required to neutralize all bearish exposure to avoid or circumvent a larger degree correction or reversal higher. Similarly, looking at the euro currency, you can see Friday's and overnight setback below the 139.13 corrective low that in fact confirms a bearish divergence in short-term momentum. But from a longer-term perspective, looking at the daily chart here, we think the key technical level for this market is the 137.75 corrective low from October 12th. That's the low the market needs to break below to confirm a bearish divergence in momentum and in fact break this longer-term uptrend, at least from the late August low at 125.88, exposing a larger degree correction or reversal lower. It is interesting on a long-term weekly log scale perspective, and we discussed this last week, that the market has thus far rejected the 141.36 level area that is the 100% progression of the previous 118.76 to 133.36 rally from the late August low at 125.88. Our high last week was 141.60, so right in that immediate neighborhood, such that if the market can confirm a bearish divergence below 137.75, we think this market's got an increasing prospect of at least a large degree correction of this rally from 125.88 that I think would cite the former resistance from the 133 handle area as an immediate target. In sum, a generally bullish policy remains advised for all but short-term traders who have been advised to pair or neutralize bearish exposure on the break below the short-term risk parameter at 139.13. But longer-term players are advised to maintain a bullish policy until or unless the market fails below 137.75, at which point moving to a neutral sideline position immediately would be advised. And finally, and given the inverse correlation between the US dollar and the gold market, it's not surprising to see a short-term momentum failure overnight below the 1356 and a half area that suggests this latest phase of the rally from October 8th's 1325 low is complete. But given the magnitude of the secular bull trend, traders are urged to first approach this interim setback as just another of numerous corrective dips this market has had to endure along the lines of this long-term bull trend, not just over the past 3 months, but for quarters and even years, in fact. And given the magnitude of this major bull trend, and you can see the developing threat of a bearish divergence in momentum, but we've had that before. Until or unless the market breaks below the 1325 spot 60 corrective low from October 8th, needed to break the long-term uptrend. This trend is up and expected to continue and perhaps even accelerate. With this past couple of days setback, again, advised to first be approached as a mere corrective dip ahead of further gains. If the market fails below 1325 spot 60, confirming this divergence, it will certainly be proving at least intermediate term weakness that we think will expose a correction of this portion of the rally from the July 28th low at 1155, the 38.2% and 50% retracements of which cut across at 1294 and 1266, which is a really interesting number because it correlates almost perfectly with former major resistance from the late June period, also at 1266. In sum, while the short-term bearish divergence in momentum and failure here is enough to warrant shorter-term traders with tighter risk profiles to pair or neutralize bullish exposure, longer-term traders remain advised to maintain a full bullish policy with a failure below 1325 required to move to a neutral sideline position in order to circumvent the depth unknowns of a larger degree correction or reversal lower. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.